The average American household loses over $3,000 a year on purchases they never planned to make. Not because of carelessness, not because of insufficient income, because the human brain was never designed to operate in a modern economy. What follows are 7 documented mechanisms that govern how the brain processes money. Each one is backed by published research. Each one carries a measurable cost, and each one is operating inside every household that depends on a paycheck, pays rent, buys groceries, or fills a gas tank.
The human brain evolved roughly 200,000 years ago in conditions where delayed rewards were dangerous. If food was available, the correct response was to consume it immediately. Tomorrow was not guaranteed. That wiring remains intact. Neuroscience research shows that when a person is offered $50 now versus $100 in a month, the brain's limbic system, the emotional center, floods with dopamine for the immediate option. The prefrontal cortex, responsible for planning and long-term reasoning, barely responds to the delayed one. The emotional system overpowers the logical system nearly every time. This pattern is known as hyperbolic discounting. The brain assigns disproportionate value to anything available immediately and minimal value to anything requiring a wait, regardless of which option is objectively superior. For a middle-class household, the effects are direct. It drives the decision to spend a tax refund in a weekend rather than redirect it toward an emergency fund. It shapes the impulse to buy now instead of save gradually. The brain is not running a budget calculation. It is executing a survival protocol that treats the present as urgent and the future as uncertain. That protocol was functional in a world without fixed expenses. In a world where rent is due on the first of every month, it works against the people running it.
In 1979, psychologists Daniel Kahneman and Amos Tversky published Prospect Theory, a paper that became one of the most cited in the history of economics and earned Kahneman the Nobel Prize in 2002. Their central finding was that the human brain processes losses roughly 2 to 2.5 times more intensely than equivalent gains. Losing $100 produces far greater psychological impact than gaining $100. They termed this loss aversion and measured its intensity at a parameter of approximately 2.25. This asymmetry functions as a natural brake on reckless spending. Parting with money is supposed to feel painful enough to force a second thought. For most of human history, it did, because transactions were physical. Money left the hand visibly. The brain registered the loss in real time. The modern economy has systematically weakened that brake. Credit cards eliminate the physical act of handing over money. Buy now, pay later services divide a single painful transaction into 4 smaller ones, each falling below the threshold that activates the brain's loss alarm. Discount framing on retail signage causes the brain to interpret spending as saving. And neuroimaging research has documented reduced activity in the brain's rational evaluation centers when discount framing is present. For a household operating on a fixed income, the neural system that evolved to prevent overspending has been functionally disabled by the payment instruments they use every day. Dopamine is widely misidentified as the brain's pleasure chemical. Research indicates it functions primarily as the chemical of anticipation. It fires in response to the expectation of a reward, not the receipt of one. The brain releases dopamine during browsing, during the moment of adding an item to a cart, during the act of clicking purchase. By the time the item arrives, the dopamine response has already dissipated. The acquisition rarely delivers the satisfaction the anticipation generated. The household-level cost of this mechanism is quantifiable. According to data compiled by Slick Deals and confirmed across multiple consumer research outlets, the average American made approximately 9.75 impulse purchases per month in 2024, spending an average of $282 monthly on unplanned purchases. That amounts to roughly $3,381 annually. For a household earning the median income, that figure represents a substantial share of discretionary spending directed toward purchases that were never budgeted and frequently never needed.
Between 44 and 56% of impulse buyers report regretting the purchase afterward. The dopamine cycle delivered its anticipation response, the transaction completed, the expected satisfaction did not follow, and the money was already spent. The commercial infrastructure reinforces the cycle at every stage. Shopping applications deploy infinite scroll to generate continuous dopamine triggers. Single-click purchasing removes the friction that would allow the prefrontal cortex time to intervene. Countdown timers manufacture urgency. Push notifications re-engage users at the precise moment the previous dopamine response is fading. Each feature is designed around the gap between what dopamine promises and what the purchase delivers. The household absorbs the cost of that gap.
In 2013, researchers Anandi Mani, Sendhil Mullainathan, Eldar Shafir, and Jiayang Zhao published a study in the journal Science examining the relationship between financial pressure and cognitive performance. They tested two populations, approximately 400 shoppers in a New Jersey mall between 2010 and 2011, and 464 sugarcane farmers in Tamil Nadu, India. In the mall study, participants were assigned financial scenarios of varying difficulty and then given standard cognitive tests. When the scenario involved a minor expense, lower income and higher income participants performed at the same level, no measurable difference. When the scenario involved a major expense, lower income participants experienced a cognitive decline equivalent to 13 IQ points, the same magnitude of impairment documented in studies of total sleep deprivation. Higher income participants showed no comparable decline under the same conditions. The field study in India confirmed the pattern outside the laboratory. The same farmers scored lower on cognitive assessments before harvest, when household finances were strained, and higher after harvest, when income had been received. Same individuals, same tests. The only variable was financial pressure. The researchers described the mechanism as mental bandwidth being consumed by financial concerns, leaving fewer cognitive resources available for planning, patience, and decision-making. For a middle-class household, this finding describes a reinforcing cycle. Financial pressure reduces the cognitive capacity required to make sound financial choices. Those impaired choices generate additional financial pressure. The people who most need to think clearly about money are operating with the least capacity to do so, not because of ability, because of cognitive load.